Joining us right now is Rick Rieder. He's the Chief Investment Officer of Global Fixed Income at BlackRock. He's also the head of the firm's global allocation team. And Rick, playing into what Mike was talking about, the idea that the Fed probably can't pretend that nothing is happening at this point. You kind of have to live up to the realities of what we're seeing out there.
Boy, I thought Mike described it exactly right. I would be disappointed. I think most market participants, if we continue down this road, the same policy that we had pre-vaccine, that is disappointing. I mean, the risk to the markets today is not that not that we need more liquidity or we may lose some of the liquidity. The system is overstuffed with liquidity today. The risk is overheating. Do we overheat on wages? Do we overheat on input costs for companies? You know, quite frankly, I mean, if they don't start to evolve this policy, then that would be concerning for me. I mean, by the way, we have to put it in perspective. People talk about, gosh, the taper tantrum and how scary this is. We're talking about a Fed that probably sometime at the end of the year, beginning of next year, may do $10 billion a month. Just put that number in perspective. The gross Treasury issuance in a month is almost $400 billion. If you take net supply of Treasuries, it's a net of what the Fed's doing. It's about $150 billion. To take $10 billion off a month to continue to put liquidity in through well into 2022, it's not that scary. Not acknowledging that the economy's in a different place, that is more concerning to me. So hopefully we get that. And my sense is they'll talk about how they discussed a plan or not a plan, discuss the idea of coming up with a plan, and then we'll hear more later.
So if you would be disappointed if they don't acknowledge that, how would you express that disappointment, just given the size of the portfolio that you manage?
Yeah, I mean, you know, the big thing is the overheating dynamic, and you know, that is, I think it's a general risk issue, and you know, I still think equities are going higher. Right? You know, we're running a bigger cash position largely because we've cleaned out all of things like, you know, the rich parts of the Treasury market. I mean, the 2-year note at 16 basis points. Who cares? We've cleaned out agency mortgages that are too rich, so we're sitting on cash. But we are long equities. We're using a lot of convexity in our portfolio. But gosh, if we don't hear anything different, you know, then I worry a little bit about risk. I mean, a system, you know, you can create asset bubbles. You can create leverage. We saw some transactions come to the market the last few days that are a little bit concerning. I mean, with literally zero spread to them for risk assets, spread to swaps or spread to treasuries. Some of that gives you some pause about markets. So hopefully we're starting to evolve. Again, it's not going to be quick. It's going to be really deliberate. But I think starting to make that move is really worthwhile. By the way, you look at some of the data in China, that's starting to slow a bit. We saw that overnight, some of what commodities have been pressured. Let's say the Fed doesn't move, and let's say the economy starts to slow a bit. You know, then how do you start to remove some of this accommodation? This is why I think, you know, when the economy is in a really, really good spot, it's time to be anticipatory and time to start to move to just really easy conditions as opposed to emergency conditions.
Rick, what you said about how you're sitting on a lot more cash these days, it sounds an awful lot like what Jamie Dimon just said about how they've got some cash that they're ready to be opportunistic when things kind of change in the Treasury market. Is that the same thought process you have? What are you planning to do with that cash?
Becky, it's a great question. So let's talk about a couple of things. First of all, holding cash doesn't hurt you. I mean, I was actually looking at the S&P 500. Right, but if you think exactly, but if you think about the S&P 500, I think after not this employment report, the employment report a month ago, I think the S&P 500 is almost exactly to the same point that it was. So, you know, markets are not doing a lot. Sitting on cash is not hurting you. And listen, you know, the thing that part of why I think we can normalize a bit, we can start to taper the program. If you moved rates back, I don't think rates are going that much higher, but if you start to move them back to where real rates are not excessively rich, we'd start to put some money to work in the rates market, in the investment grade credit market more than we're doing today. So we just like to see a bit more of not distorted levels so that we can put some more money to work. So, you know, like I say, holding that cash gives you that ballast to do it.
Shepard Smith here. Thanks for watching CNBC on YouTube.